Good morning, students. We have done so far 2 video classes and this is the third one, and we are continuing with our chapter Money and Banking, that is chapter 2 from unit 2 of Introductory Macroeconomics. A very good morning to you all, and hope you are all are healthy and staying safe at home. So in order to utilize these video classes, you must write this material in your notebook and revise it. And we have done so far we have done 2 video classes, and the slides which we have done is the introduction slide and the functions of the central bank and the functions: issue of currency, banker to the government, banker's bank, lender of last resort, custodian of nation's reserve, controller of credit. We ended our second video class on this function, and I hope you have revised these 2 video classes, and now you are eagerly waiting for the third one. We are now aware that these are the 6 quantitative measures to control credit, and the Reserve Bank of India, the central bank, uses these measures to control 2 situations: inflation and deflation. And the measures are quantitative measures are these: bank rate, open market operation, cash reserve ratio, statutory liquidity ratio, repo rate, reverse repo rate. And the qualitative measures are margin requirement, rationing of credit, and moral pressure. This we have done so far. Now this is the new slide for this third video class, and our first measure to control credit in the economy is bank rate. Look into the slide, and the definition is: bank rate is the rate of interest at which central bank lends funds to commercial bank for long term. You are aware that central bank is the apex bank, and it controls and regulates the commercial banks. Commercial banks can borrow from central bank in case of need. So bank rate is the rate at which central bank lends funds to commercial bank for long term. Commercial bank can borrow, but they have to pay the rate of interest, and that rate of interest is bank rate. Very simple. And as a credit control measure, central bank uses this bank rate to control inflation and deflation. Look into the slide. During inflation, central bank increases the bank rate, and how it works we'll understand this in the next slide. And during deflation, central bank decreases the bank rate, and how it works, this is the slide. This you can understand that during inflation, if there is situation of inflation in the economy, inflation means continuous rise in prices. Hindi में हमने पढ़ा महंगाई. Then which we now as students of economics, we know that this situation is not good for the economy. So central bank intervenes. They increases the bank rate, and if the bank rate is increased, the borrowing become costly for the commercial banks. If they are getting the funds at the higher rates, then for the public, that rates will also increase, the interest rates. For the people like us, we borrow from commercial bank. Now I think you understand it. We borrow from commercial bank, and commercial bank borrow from central bank. Then in both these cases, if the rates are high, then what happens? Commercial banks will borrow less. Fourth point. Fifth, if they will borrow less on whatever funds they are having, they will increase their lending rates to the public. Lending rates means the rate of interest which we have to pay as the general public. Then if the rates are high, then as a public will borrow less. Borrowers will borrow less from commercial banks and spend less. Now this is for the first time you need to understand that how borrowing is related to spending. Now you must concentrate. What I am trying to make you understand, that borrowing means that credit is related to spending. How? Because now in macroeconomics you need to understand that credit is used by these investors, by these companies for their production process, means output. If the output is increased due to the credit is available with these firms, then more output leads to more income. That also you need to understand, that more output means more factor payments because these are the factors which are involved in the production process. This is for the first time you are trying to understand that output, that credit is related to output. More credit means more output means more income. Because income, why more income? Because in the output process, in the production process, when the output is increased, more factor payments are there. Factor means those who are involved in the production process, and factor payments means in the form of rent, interest, wages, profit. If the more output is there, more factor payments are there, more income, and then more expenditure, which will increase the demand. But if the less credit is there, then it will affect the output process. Then there will be less factor payments. Less factor payments means less expenditure. Less expenditure means the demand will be less, because then now the income is less, and this results in fall in aggregate demand. This reduces inflation. Again, give it a look. If you are in a position to understand this slide, then this chapter is will be very easier for you to understand, because all the other rates will work in the similar fashion. During the case of inflation, the credit flow is reduced. During the case of deflation, the credit flow is increased. Similarly, in the case of deflation, central bank decreases the bank rates, borrowing becomes cheap, commercial bank borrow more, and this decreases their lending rates to public, and the borrowers like us will borrow more from commercial banks, because now the rate of interest is less and will spend more. And moreover, we are talking about borrowers, the firms, and there will be rise in aggregate demand, and deflation reduces. Again, try to understand that during deflation, central bank decreases the bank rate. If the rate is less, when the commercial bank will borrow, and the third point which we have clearly written here, borrowing becomes cheap for the commercial banks. Commercial bank will then borrow more, and if they are having more credit available to them, more funds are available to them for credit creation, then they'll decrease their lending rates to the public, and because now the rates are less, then the borrowers will borrow more from the commercial banks, and then they spend more, and there will be rise in aggregate demand, and deflation reduces. Now give it a look to cash reserve ratio. Here is the ratio of bank deposits the commercial bank has to keep with the central bank. And during inflation, the CRR is increased. During deflation, the CRR is decreased. So CRR is the ratio of bank deposits the commercial bank has to keep with the central bank. They cannot use for creating credit. So during inflation, to reduce credit, that CRR is increased, and during deflation, the CRR is decreased. From this slide we will continue in our next video class. Again, give it a look. We will start from this credit control measure, that is CRR. We have done so far bank rate. Now I think you understand that the definition of bank rate and how the bank rate reduces, we can say expands or reduces the credit. And now we have done CRR. The definition is clearly written. CRR is the ratio of bank deposits the commercial bank has to keep with the central bank. From this slide we will continue our next video class. Thank you.